Good evening, everyone. Welcome to our MQ Trader webinar on the topic of Singapore bank and REITs sector. I'm Casey, the host for today's event and also one of the MQ Trader team. Hi, Xu Wen, April. Okay, so can I have a quick mic check? Please type 1 in the chat box if you can hear me clearly. I saw some of you say hi already. If you can, please type 1 in the chat box, can hear me clearly. Apparel, okay, thank you. You're the first one. W. Kai, Mario. Thank you. Okay, everyone say 1 already. So thank you for your response. I believe you can hear me clearly. Let me start with a brief introduction to MQ Trader. MQ Trader stands for Malaysia Quantitative Trader Group. We use quantitative methods to do our analysis, and we've developed the MQ Trader stock analysis tool. This is a tool that we bring what normally only available to large institutions to our MQ members. So we seek to empower them to make quicker decisions and with greater confidence. So to subscribe to MQ Trader service, you just need to open a trading account with M Equities LYH team, which is one of our selected advertisers, to enjoy free subscription to MQ Trader. This subscription also includes MQ E-Trade, stock analysis tool, MQ Points, MQ affiliate program, and many more rewards. And this is a showcase of our MQ E-Trade. You can see live market quotes on this system. You can also view our exclusive MQ trading signals and also up to 10 market depths and also other information about the counter at a glance. So do check out the links for more information about MQ E-Trade. And this is our MQ Trader stock analysis tool. In this system, you can get buy and sell signal with just 1 click. You can also do back tests to test the signal's past accuracy. And again, you can visit the link for more information. So for MQ traders, you can link your trading account with MQ account. Then you can start accumulating MQ points every time you trade. And you can redeem rewards at our MQ Marketplace and MQ Dummy, including vouchers, MQ merchandise, books, online courses, and etc. So do remember to link your trading account with MQ Trader account. You can inquire with our support team for more information for linking the trading account and also MQ account. Speaking about our marketplace, we have this Merdeka sales. Tomorrow is our National Day. So we are going to have up to 30% discount on all items on our marketplace. So do remember to check it out tomorrow on the 31st of August. So just to summarize, these are the benefits you can get if you open a trading account with our selected advertisers. For today only, you can also get extra 500 MQ points today. So if you're interested, please type 3 in the chat box or submit your contact details through the QR code or the link shown on the screen. And the respective team will guide you on the next step. James, okay. So for those who type 3, our support team will contact you shortly for the next step. Okay, check-in rewards. For MQ members, our current MQ members, you can get a bonus of 300 MQ points as check-in rewards for today's webinar. There will be a quiz sent to your email shortly after the webinar ends. You just need to upload a screenshot in the post-webinar quiz to claim your check-in rewards. And I'll pause here briefly. You can take a screenshot now. This screenshot can be submitted to our quiz later on to claim your check-in rewards. So do take your screenshot now while I pause here briefly. I saw some of you type 3. Our support team will contact you shortly, so do respond to them as well. By the end of the webinar, we will be giving out mysterious gifts worth up to 249 ringgit today. So do stay tuned for it. If you have not registered for the webinar, we encourage you to register now. You can scan the QR code on the screen to register. You can also, by registering, you can actually get our post-webinar updates, including webinar recordings and also the quiz where you can claim your check-in rewards. So I'll pause here briefly for those who want to register now. And a gentle reminder, you need to upload a screenshot of today's webinar to get the check-in rewards. So if you haven't taken the screenshot, you can take it now as well. We will also be having Q&A session later, so please feel free to send us your inquiries throughout the webinar. We'll compile them and send them to our speaker by the end of the webinar. Thank you for your response, Theo. So on today's topic, this year was thought to be a year of recovery after the pandemic. However, we are now facing hawkish monetary policy and also geopolitical uncertainties. So in this webinar, we will look at how we can use Singapore bank and REITs counters as a safer asset choice for wealth preservation and also accumulation. Today, we also invited Mr. Ong Ju Pan to share with us. He's an experienced investor and also a financial bloggers on various platforms for more than 5 years. He's also a SGX Academy speaker. It is a pleasure to have Ju Pan to share with us today. So are you guys ready for him to start sharing now? Can you type ready in the chat box to let me know you're ready? Mario, you're the first one. Thank you for your response. Hun Kim? Lo, okay, Leonard, yeah. I'm waiting for more ready. Okay, so there are many people coming in and ready. So since everyone is ready, I would like to invite Ju Pan to share with us now.
Hi, thank you, MQ Trader.
I'll pass the time to you.
All right, so thank you, MQ Trader, for hosting me. And I'm very much pleased to actually become the panelist of today's sharing. But before I actually go into my topic, I just want to maybe just mingle around with you guys. Who among the audience who are Malaysians? If you are Malaysian, type 1 in the chat box. Let me know who are the Malaysians here. I see a lot of Malaysians. Okay, so in a way, it is a very, I would say, special occasion. Personally, I'm also Malaysian as well. So yeah, I'm actually talking to you guys or sharing with you guys on a very honest way of actually going through my presentation or sharing today. So it also is a surprise because as a Malaysian, why are we actually here talking about SG banks and Singapore REITs, right? Because we do have our banks in Malaysia. We do also have REITs in Malaysia to invest, but why are we actually looking into Singapore, right? And hopefully through this presentation, this sharing, I can actually really spill out the facts and figures to you guys and let you guys really go through it and hopefully maybe make a change in how you invest in the coming days, right? Starting tomorrow or in the coming days, where you actually have more courage to actually invest outside of your home country, Malaysia. Right. So of course, today's title will be focusing on SG banks and Singapore REITs. If there are questions on other companies, I might be able to share if I am aware, but most likely we will be focusing more because as of now, I think the current market conditions is basically a little bit more bearish. Markets is uncertain. Of course, if you think the markets are bullish, you can let me know by typing 2 in the comment section. I don't think anyone thinks the market is in a bullish mood right now. So we are more in an uncertain period time, right? And during uncertain time, doesn't mean that we do not invest, doesn't mean that we take away our cash and hold it in any ways, but we still want to actually stay invested in some solid and defensive counters or companies. So of course, in this sharing, we'll be touching on real companies, real banks, real REITs, and it will be a personal opinion. It will also be just a sharing session, but do not take it as a buy, sell, or hold. Please do your due diligence, analyze more before you make any decisions in your investment, you're making any investments decision. Right, of course, you can see right here, this is, I would say, currently Singapore. If you actually have the opportunity to look at Singapore from a skyscraper, you see that it is actually a very futuristic looking country, right? There are skyscrapers and the architecture is actually one of a kind, right? You straight away, you see MBS, you won't think that it's taken from other places. And you also have the different kinds of, Gardens by the Bay, many tourist attractions, all man-made, right, by the Singapore development and also how Singapore has progressed along the years. But if you fast forward during a time period where Singapore was just similar to Malaysia, when we just obtained our independence, or even before we actually got independent from the British, Singapore was just like many parts of Malaysia, right? It was actually a strategic place as a port for trading activities. We have actually learned that in our sejarah, right? And it slowly actually evolved, grew, and developed to where it is today. Right, the same goes to Malaysia, but if you actually take a look at the map, right, of Malaysia and Singapore, you notice that how small Singapore actually is, right? It's not even, it's even, I think it's almost the same size as Perlis. And to think that a small country with the land mass of just Perlis, right? And today we are talking about countries listed inside this country. It'll be like, why is it worth your time to actually go through this sharing with me? Right? There must be a reason. And why a country so scarce of land, right? They don't have land. It means they don't have a lot of resources. But how can this small, scarce land country actually become one of the country or one of the world's leading country in terms of economic development and also other aspects as well? So if you look deeper into Singapore's map, you can see that originally the natural land mass of Singapore is just the one in white color. So the Singapore government is also aware that land is a very crucial asset, right? And they are running short of it. So eventually there were multiple rounds of land reclamation, meaning to say that they actually took back the imported sand from Malaysia and other parts of the world, and then they eventually made more man-made lands, and then that actually helped to spur them in terms of many aspects, more land to build properties, more land to build mega ports, right here in the land of Tuas. So there was a very, very stringent and clear-cut direction on how they want to tackle the shortage of land in a country of like Singapore. So if you look at, or you go into Singapore's ura.gov.gg, which is the Urban Redevelopment Authority of Singapore, you see that every 5 years, the Singapore government will relook at the entire map of Singapore and say that, okay, for this part of Singapore, what am I going to do with it? Is it going to be a business district? Is it going to be housing developments for Singaporeans and also talents that are actually coming to work in Singapore? Or do I want to actually make it into a park or an industrial area or port to help to boost up economic activities? So every different color shaded inside the Singapore map has a purpose, already has a plan. And when this plan is communicated out, right, and then property developers or construction companies will come in and say that, okay, there's a project, here is my bid and here is my plan. So they will come in and they will collectively plan the growth of Singapore by looking at which part of the land is actually going to be made into whatever, repurposed into for whatever activities, right? So when I say that it is very sophisticated, it really, really is very sophisticated. There are many colors inside the ura.gov.sg map. Different colors serve different meaning purposes, right? And when you have such a detailed game plan to develop your country, that means the property companies, the REITs here are going to be world-class because you only have this much of land, right? You want to be very efficient in using the land for development, be it for shopping malls, be it for office properties, be it for whatever kind of property, it has to be efficient. That's why you see a lot of high-rise properties in Singapore, right? Because you want to actually cater to a growing population, yet your land mass will not grow as fast as your population. So everything has to be very efficient, and hence you have a lot of world-class REITs in Singapore, and these are all or mostly Singapore born and bred, and then they actually have grown a lot and grown together with Singapore as well. So one of the benefits or advantages of a Singapore REIT compared to Malaysia is actually that in terms of the distributions, or we call dividends for REITs, is that if you are an individual investing into a REIT in Singapore, in Malaysia, let me get this straight, you must be aware of it. If you invest in a Malaysia REIT, right, whatever dividends or distributions the REIT pays to you, or before they pay to you, 10% of it is withholding tax. You have to pay it to the government, right? And you get the remaining 90% of what the REIT declares. Coming to Singapore, you get 100% of what the REIT distributes out. There is no 10% withholding tax if you are investing as an individual. So from one first stage in terms of the tax concession comparison, Singapore is already leading ahead. So even if you are buying 100 ringgit worth of Malaysia REIT and also 100 ringgit worth of Singapore REIT, if they pay out 1 ringgit of a dividend, you get 90 cents because there's a 10% tax concession from Malaysia. But if you invest in a Singapore REIT, you get 100%, which is just the whole 1 ringgit, right? Every year you you pay less than 10% because you invest in a Singapore REIT. In the long run, there will be a compounding effect in your returns compared to investing in a Malaysia REIT. Of course, there are other benefits to a Singapore REIT. One of the more important ones would be the development quota. So for REITs, sometimes they need to throw in money or invest money to build properties from scratch. Like they do not usually go out and buy ready-made properties. So there's a cap on how much projects that these REITs actually have to, how much of a cap that these REITs actually have to control. Well, for Malaysia, they can only use up 10% of their total assets into development of their projects. But for Singapore, it's 25%. Meaning to say that the Singapore REIT is given much more freedom into developing new properties from scratch, and that is actually going to be much advantageous because you don't buy ready-made property, you actually save up. If you actually have the so-called sister companies to help you build the properties from scratch. Of course, I see questions coming in. Of course, if you have questions, you can actually list them down in the Q&A section. We will actually go through them after the sharing session. Right. So of course, you would also be surprised that apart from Singapore born and bred REITs, there are also other REITs, coming to list in Singapore Exchange. And we are talking about REITs having properties in Japan. Say, for example, Daiwa House Logistics Trust, 100% of their properties are in Japan, but they chose to list their REIT in Singapore. Digital Core REIT, a REIT that is in the data center scene. I would say mostly also outside of Singapore as well. Their properties around US, right? They are also listing their units in Singapore Stock Exchange. Sasio REIT, a REIT in the retail scene, but properties in China, also listed their REIT in Singapore Exchange. So goes for Manulife US REIT, EC World REIT, and Elite Commercial REIT. And that also falls back to the tax concession that I talked about just now. So in many parts of the world, the dividends are usually taxed. So for US stocks and REITs, if you invested into them, you'll get taxed 30% before you actually receive your dividends. But if you choose to list them in Singapore Stock Exchange, then you get to enjoy the tax-free concession for every dividends that are paid out, right? So you might ask me, JP, I already have 18 choices in Malaysia, right? There are 18 Malaysia REITs for me to choose. I don't need to buy every one of them. I just need to buy maybe top 3, best of the best. And why do I need to put my, emphasis, time, effort to look into REITs in Singapore? Well, I have 44 here in Singapore. And out of these 44, maybe some of them are even better than the Malaysia REITs that you have, right? So if I were to nitpick and choose some very good REITs from Malaysia and also Singapore, and I compare them on a 5-year historical return, I plot them from start, say for example, in the start of 2017, right, in 2022. So 5 years back, the 1st of January, every REIT has the same starting point. And up to today, what are the returns of these REITs? So this is adjusted returns with dividend adjusted, meaning to say that all the capital gains and the dividends add up together, which REIT is actually giving you the higher returns. So you can see from the red line or the blue line and the red line, you can see that it's a little bit, I would say, complicated if you look at the color schemes. But if I were to make it the chart right here, right, you have at the top Parkway Life REIT, 5-year returns 156%. In second in place, Mapletree Industry Trust, 125%. So top 2 spaces are actually accommodated by Singapore REITs. Third place, Atrium REIT, we have from Malaysia representative at 93%, and then Mapletree Pan Asia Trust at 80%, and then Ascendas at 74%. So basically, if you look at the top 5 positions, only one Malaysia REIT managed to come head-to-head or shoulder-to-shoulder with the Singapore REIT's historical 5-year performances. And your well-known Malaysia REITs in the likes of Pavilion REIT, Sunway REIT, IGB REIT, right? Pavilion REIT is still negative as of today. IGB REIT only 42% or 43%. Sunway REIT also only just 15%, and then Axis REIT at 56%. Right? This is just 5 years, huh? So any of the big REIT, if you invested in Malaysia, you're probably behind versus the so-called other Singapore REITs out there for the past 5 years. What if I pull the timeline, the starting point back to 10 years ago, right? 2012 until 2022. Right, what are the differences going to be? So first place, you have Singapore REIT at 288%, Mapletree Industrial. Second place, Parkway Life REIT 352, Mapletree Pan Asia at 300%. And then from here, you can see a very, very scary differences. Why are all these Singapore REITs occupying the top 4 positions? And even if I take Ascendas REIT at 198%, it is still outperforming Atrium REIT by around 20%. And if I just take the bottom of the bottom, which is IGB REIT 97%, you are actually losing out close to 100% over across 10 years if you choose to invest in IGB REIT compared to Ascendas REIT. And this actually excludes the exchange rate losses due to the weakening ringgit. So we are all aware that ringgit has been weakening, right? If you are planning to go overseas now that the borders open, you would be aware of how the ringgit has been weakening against a lot of other currencies, be it the USD, be it the Sing dollar, right? And this actually does not include the ringgit weakening effect on top of the overall absolute return. So something must be wrong, or I would say something, the Singapore REITs must be doing something right to be able to achieve better than expected 10-year historical returns compared to our Malaysia counterparts. So what could be the reason? So if I were to actually make it very simple for you to understand, for a REIT to actually grow, right, it must actually grow their top line and bottom line, right? A REIT essentially is a business where they actually invest into multiple investment properties. They collect rental, and then once they collect the rental, and then they pay out the net profit as dividends and distributions to the unit holders like you and me. So for a REIT to continuously pay more and more distributions year on year, they must be doing some growth initiatives. They cannot be just sitting on 2-3 properties for the last 10 years and expecting dividends to grow like magic. This cannot be the way. And if you look at just randomly chosen REITs of Singapore, you can see that, for example, right here, you have Parkway Life REIT, a healthcare REIT actually owned by IHH Healthcare Berhad, our Malaysia healthcare company. So they actually choose to list their healthcare REIT in Singapore. So you can see that they have been growing their top line revenue and also their net profit as well. So once this portion is taken care of, business is growing, rental is increasing, then only they can have the capability to pay you more dividends year in, year out, right? This is one way to actually grow. The second way would be to buy as much properties as you can from the market out there. Every year, if there's an opportunity to grow your portfolio, just like investors, right? Today, market is red. You think that you've come across a very good stock, buy it. Same for REITs. If there is a good property that can actually generate a higher, net property income, buy it. So you can see Mapletree Industrial, every single year, they have been on an acquisition spree. That is why they can grow their net revenue and also their net property income. And once that is actually grown into a substantial size, they can actually afford you to pay you more and more dividends on a year in, year out basis. So growth in property portfolio is very, very important. And we do not see a lot of it coming from the Malaysia REITs. This, they have to back up, right? And this is what the Singapore REITs have been actually showing. All the top performance ones, they are actually doing something to grow, right? Second, not only you need to grow your net revenue or your net income as well, the per unit accretiveness also has to be there. So whenever we buy stocks or whenever we buy REITs, right, we always say, okay, let's say, for example, I want to buy 2,000 ringgit worth of IGB REIT. And what is IGB REIT price today? 150, 140. So you have to divide it, and you roughly would know that how much unit you would be holding on if you allocate this amount to buy a certain stock or a certain REIT. So every unit of this share or REIT has to actually grow as well on top of the net revenue and net income. So we have come across multiple scenarios or examples where, the company's doing well, business is good, but there is a, mismatch in terms of the outstanding shares on outstanding units. Two much of the shares have been, say, for example, too much bonus issues, too much stock splits. There are more and more outstanding shares in the market. And hence you see that even though net revenue and also net income is growing, but the earnings per share, the earnings per unit, the dividends per unit, the dividends per share does not tag onto the growing trend of the revenue and the net profit income as well. So this is also very important, because if you want the share price or REIT price to actually grow as well on a per unit basis, it also has to grow as well, right? So this is where we see growing dividends per unit, growing net asset value per unit. The per unit accretiveness has to be there. So from here you can see Mapletree Industrial for the past 10 years, dividends has always been going up, right? Per unit basis, not just on a pro forma basis, but also on a per unit basis. Same goes to Parkway Life REIT, right? Every year I am increasing my dividend payout per unit to my unit holders. The third, I will say, and one of the more important factors is that they are actually very, very willing to expand outside of Singapore, right? You inside Malaysia, you can argue with me that 18 REITs listed in Malaysia, but more often or not, I can only think of one REIT in Malaysia that actually has properties outside of Malaysia, and that would be your Hospitality Trust, right? By YTL. So you have hotels in Australia, you have hotels in Japan, but the other REITs, they are very, very happy with just focusing on property investment in Malaysia. And if you understand the entire property investment scene in Malaysia, you know that it will not actually do very, very well in the 10, 20 years down the road, because there are many factors which we will not talk about. But if you look at how Singapore REITs, they are aware that their land mass is small, right? Sooner or later, every properties will be owned by someone in Singapore. So how can I continue to grow? Well, the world is free. The oyster is in your hand. You can actually choose to buy up properties in Malaysia. You can buy properties in Japan, for example, Parkway Life REIT, right? Healthcare REIT listed in Singapore Exchange, but that does not mean that they cannot go and invest into healthcare properties in Japan. Mapletree Industrial started off as a REIT just focusing on industrial properties, factories, warehouses in Singapore. But then I think I would need to grow out from my original business plan and go into data centers. So I'm buying up data centers in the US, and hence this is how you see REITs, even though in a very, I would say, traditional property and scene, slowly emerge and pivot themselves to invest into upcoming kind of properties and make themselves becoming relevant throughout the years. And last but not least also is to actually invest into properties outside of not just Singapore, but also around the world. Like, for example, you have properties in China, Korea, and also Japan from Mapletree Pan Asia Trust. So this is one of the stark differences if you compare Singapore REIT that is outperforming compared to a Malaysia REIT, which is daring to go outside of their home country to invest and grow their portfolio. Right. Last but not least, I think would be how good they are in terms of doing what they are best. So Parkway Life REIT has always been one of the best healthcare REITs to invest in. So they have been very, very focused into growing their healthcare properties. So they have hospitals, world-class hospitals in Singapore, and they also have world-class nursing homes in Japan. And for Mapletree Industrial Trust, started off, you see, back in 2010, flatted factories, 53%, all the industrial properties. And then coming to 2022 of March, more than half of their properties right now are data centers. So this is a pivot that I'm talking about, right? They cannot always be focusing on industrial properties. There is a need to actually evolve, and Mapletree Industrial Trust actually took 10 years to change 53% of their flatted factories properties into investing into data centers. And last but not least, one of the very frequent incidents or events that you will be actually noticing would be merging of REITs, right? So you see, like, for example, CapitaLand Mall Trust, CapitaLand Malaysia Mall Trust sister REIT, but listed in Singapore, right? It was fully 100% shopping mall focused REIT, merging with the other counterpart, CapitaLand Commercial Trust, REIT that is focusing on office buildings, commercial properties, coming together joining together as one and becoming a better REIT, right? Having properties not just in the shopping mall, but also in the commercial scene as well, right? They are very good at that, and they're always evolving and always improving, right? And of course, if you are aware of what is going on in Singapore, you will be also aware that Singapore's NTUC, one of the cooperatives, they also are into property investment, but they have recently chosen to divest their more properties. And of course, whenever this kind of news flow to the market, you have the other commercial REITs coming up and say that, oh, I want to buy from you. How much is your property or collection of properties? So inside the news right now, you have other commercial REITs, like in the likes of Capital Integrated Commercial Trust, like the combination of Capital Land Mall Trust and Commercial Trust, and then Fraser Centrepoint Trust and also Landlease Commercial REIT coming together and bidding to actually buy up properties that NTUC MacArthur's wants to dispose. Because these properties are very high quality, they actually pay out very good rental income, and that is why the REITs, even though they are very big already, they are still hungry for growth. And these are the REITs that are actually in line to actually compete with each other to buy up this 3.7 billion worth of retail and office assets. Right. So to bring you guys deeper and to understand Singapore REITs even more, I've chosen to just share with you guys one particular REIT. And hopefully, by going through this simple case study, you actually would come to awareness that, hey, it isn't that difficult to analyze and also understand a Singapore REIT. Because I purposely chose this REIT because if you ever came to Singapore before, you would have actually ventured into their properties, right? So the stock cap, the REIT that I'm going to share with you guys will be Capital Land Integrated Commercial Trust. The stock code will be SGXC38U, right? If you ever came to Singapore before, chances are you would have visited a CICT mall, right? If you've ever been to Bugis Plus, right? If you have been to Bugis and you have been to Bugis Plus and Bugis Junction, chances are you have already bought something from a CICT tenant, right? And if you are someone who tends to be on a party animal side, you have ventured and went to Clarke Quay, well, you have also ventured into CICT's property and have actually spent money there and helping to grow CICT during your holidays. Right. Of course, Singapore is a very small country. When you travel around or when you actually take a public transport or Grab, going past the central business district area, the CBD area, you come across a lot of high-rise and skyscrapers, right? So they are also part of CICT's portfolio, right? You might not recognize them, but if you actually look closer and take a memory, take a deeper look at them, you might actually have zoom past them when you're actually traveling. So some of the notable examples would be Capital Green, Asia Square Tower, and also Capital Tower and Capital Sky. So these are properties that you are aware of, right? Malls that you have probably ventured into when you come to vacation in Singapore. Right. So one step is very straightforward. You have actually visited there and you have actually have an impression of the crowd levels, the footfall traffic. Then you look into other aspects of it. So being a REIT that has multiple properties in Singapore, we want to see how diversified or where are the properties located in Singapore, right? You can see that the office buildings are mostly situated in the central business district area. So these are the places where you have the photos of Singapore with the high-rise buildings. So these are mainly the office buildings situated at. Of course, there are also more situated in Raffles City, right? In Orchard. So probably if you have ventured to that area as well, you've also visited to one of CICT's more portfolios there. But if you are someone who are not that, you're not visiting the central part of Singapore, you probably come visit your relatives and they are staying, say, for example, Jurong part of Singapore, or probably in Bishan area. So there are also suburban malls managed by CICTs, and you've probably also entered these malls as well. So not only are the properties focused in central part of Singapore, but they are all over Singapore, right? And on top of that, not only CICT has properties in Singapore, but they also started to invest outside of Singapore, right? Your properties situated in Frankfurt, Germany, and properties situated in Sydney, Australia. So here are some of the properties that CICT owns, situated outside of Singapore, right? 2 buildings situated in Sydney CBD, and also 2 buildings situated in Frankfurt, Germany. So once you get a gist of what properties that a REIT owns, you look at the big numbers, right? Historically, for the past 10 years, the REIT's performance has been stable, right? You can see that in 2021, there's a sharp uptick. This was the year where just now we mentioned Capital Land Mall Trust and Capital Land Commercial Trust actually merged together, and hence the combination of the revenue actually made a one-off spike. But if you were to just focus from 2012 to 2019, everything was actually going on an upward trend. Coming to 2020, what happened? The pandemic. So it got affected, but not that much, right? And it's still profitable for the past 10 years, even though for the past 10 years, we have gone through a lot of unexpected events, right? And it's stable, right? And if you look purely based on the first half 2022 results or performances of CICT REIT, you can see that everything has been showing nothing but recovery, right? Top line, year-on-year revenue growth, 6.5% increase. Net property income, year-on-year growth, 6.2%, right? Overall, if you split down into their office buildings, you can see that it's growing as well, from 192 million up to 240 million. Even the integrated development performances, the malls and the other hybrid properties that function as both offices and also malls, have been showing improvement as well, right? That is already what we call recovery shoots based on the first half performances of CICT. And if you look at the tenant profile of CICT, because now it owns properties in the retail segment and also in the commercial segment, you can see that their tenant pool is very diversified, right? The suburban retail contribute 31%, the downtown retail, the ones located in the CBD area, 26%, the CBD office, 26%, and then the other small initiatives and the so-called growth into outside of Singapore, Australia and Germany come to around 4.1% and also 1.6% respectively. One of the important things to also take a look on would be the debt maturity. So when REITs buy out investment properties, chances are, or most likely, they will usually utilize debt, borrowings from banks, borrowings from shareholders, unit holders, and they also will utilize capital from the unit holders as well. So this is where the REITs will come knocking at your door. Hi, I am actually looking to buying up a new property, and due to the regulations, I might need your help to actually pump in more capital and also use a combination of debt and actually buy up this property. This property is actually going to grow your dividends in the future. So are you okay with that? So for REIT holders, pumping in capital will not be a big issue, but we do not want the REIT actually going on to taking on too much debt and then actually having a very lopsided debt maturity profile. So say, for example, if a REIT actually has their debt maturity, say, for example, now it's 2022. If a REIT actually has 50% of the debt maturing by 2023, if the REIT suddenly doesn't have enough time to renew the debt, and then something will actually occur, is where the REIT is actually short of capital to pay back the loans and pay back the debt that they actually incur. So we want to have a well-staggered debt maturity profile. So if there is a rule of thumb, which is just basically not more than 20% or not more than 30% of their total debt maturing in a specific year. So from here, you can see it's very straightforward. Each year coming in the future, around 12%, 15% of debt will be maturing, and that is more than enough time for the REIT managers to actually roll over their debt or actually renew their debt with the financial institutions. After you have gone through the key important parts, right? You are very happy of the REIT's profile. You are very happy with the strategy that they are actually embarking on to grow. Then next, only you look at their per unit performances. So For unit performance will be very straightforward. Basically, you just look at the earnings per unit and also the net asset per unit attributable to unit holders. So for every unit that you're holding, is that particular unit actually growing year in, year out? So you can see that it has been stable for CICT, just that there is an exception in 2020 when the REIT got affected by the pandemic. But coming into 2021, you can see that it has actually sharply rebounded from the low. And you look at the net asset value per unit, every single year, the REIT is actually growing the valuation of their properties. And as a unit holder, holding on to a portion of these properties also make your REIT unit much and more valuable as the time goes by. And lastly, you also want to look at the ability of the REIT to pay you increasing dividends and increasing distributions. So it has been stably going up, save for what happened in 2020. But apart from that one-off drop, it has actually slowly rebounded, and time will actually tell whether CICT will continue to go back to their 11 or 12 cents distribution per unit and actually growing past that threshold of their historical high DPU per unit. Once everything is actually set, you're happy with their performance per unit basis, next is to just look at the valuation, right? If you want to look at it as a 10-year or a 10-year valuation, you can see that you can actually plot the dividend yield and also the price to book value ratio of the REIT. And you can see that if you are looking at a white line, which is the dividend yield of the REIT, it is currently trading at around 5%. Historically, there was a time that it was trading at 6% plus. I would say that right now it would be close to their average return, right? A long-term average return of CICT. If you look at the blue line, which is the price to book ratio, sorry, the right line will be the price to book ratio. The REIT is now currently trading at 1 times its price to book ratio, meaning to say that you're using 1 ringgit or $1 to buy $1 worth of property, which is, in my opinion, quite fair to consider for a REIT like CICT. So for REIT, for Singapore REITs to grow and capture market share and eventually paying out more and more dividends, they do not just function alone, right? They also need to have good, solid financial institutions to give them loans, trusting them, and then growing together with them. And this is where we come to the banks of Singapore, right? In Singapore, we only have 3 listed banks, very simple compared to Malaysia. So the 3 listed banks would be DBS Bank, OCBC, and also UOB, right? And if you're curious on how big the Singapore banks are, you can just take a look by the total assets, right? At the top, DBS Bank, 509 billion USD worth of total assets. OCBC Bank coming in second, 402 billion USD. Third place, UOB Bank, 340 or 341 billion worth of total assets in terms of USD. The biggest bank in Malaysia, Maybank, only has 213 billion worth of total assets. So that is roughly 1.5 times smaller compared to UOB, and roughly or more than 2 times smaller than DBS Bank. So imagine the size of the Singapore banks when you compare it against Malaysia's largest bank. And you might be asking me right now, haha, JP, checkmate. You might be talking about the diversified, the many choices of and quality of the Malaysia REITs, the Singapore REITs just now, right? But coming to banks, in Malaysia, we have 10. Definitely, in terms of quality, we will beat you, right? We only have 3 in Singapore, right? So let's also take a look at the historical returns of Singapore banks and also Malaysia banks. Again, you might be saying that there are a lot of lines right here, but if I were to tabulate the returns of the many banks I've chosen, all 3 Singapore banks against some of the well-known Malaysia banks into a table, here you have the 10-year historical returns adjusted for dividends. Top place, the DBS coming in at 324%. UOB, second place, 158%. Hong Leong Bank coming at third, 155%. Public Bank coming in at fourth at 139%. And last but not least, occupying the 5th spot would be OCBC, 118%. So out of the top 5 places, Malaysia banks occupy third and fourth place. Your Singapore banks occupy the first, second, and fifth, right? And this is of course again excluding the exchange rate losses due to the weakening ringgit. And you might say that okay lah, no need to look at Singapore banks already, because 10 years you already show me that there are actually top contenders, top banks in Malaysia that can compete head to head with your Singapore counterparts. But what if I just look at the past 5 years, right? 10 years ago, it was great. But if I just look at 2017 until 2022, what are the rankings of the banks in terms of historical returns? So 5 years historical return, DBS still maintains top. Second place, Hong Leong Bank at 84%, OCBC third place 71%, UOB at 68%, and on the fifth place would be your Maybank at 65%. So other banks like RHB, Hong Leong, Financial Group, CMB Group, and even Public Bank, even the most stable and most solid bank in many Malaysians' opinion, only coming in at 40%. So this means to say that for the past 5 years, starting on 2017, if you chose to invest 100 ringgit into public bank, you'll be getting a 39% return or 40% return. But if you choose to invest 100 ringgit into TBS Group, you actually will be getting 138% return. And that is actually more than 100% outperformance compared to public bank, right? So you need to take that in mind. Why are Singapore banks still growing at a faster rate compared to a Malaysian bank? So if you think that the Singapore banks can continue to outperform, then chances are 20 years down the road, you will see the list will be even more skewed. You will see that the Singapore banks would occupy the top 3 spots, while your Malaysia banks will be occupying the bottom spots. So what is actually happening, and why is this actually happening? So one of the key important factors that also apply to the REITs is that Singapore banks are aware that there are only this much businesses I can do in Singapore. It's a small island, right? 6 million population, right? After I sell everyone a loan, a house loan and a car loan, that's it. And even the so-called SME, the corporations, I need to find more ways to grow my top line and my bottom line. What do? I venture outside of Singapore. I can also go into business in Hong Kong, China, many parts of ASEAN, and also other parts of the world. So you can see that for all 3 banks, you are mostly very familiar with OCBC and UOB because they have significant presence in Malaysia, right? 18% of OCBC's profit before tax comes from Malaysia. 10% of UOB's profit before tax come from Malaysia. And you might not be aware of DBS because they do not have any operations in Malaysia, but going to countries and places like Hong Kong, China, DBS actually has a huge base as well in that respective countries. And one other aspect, Singapore banks tend to outperform or are better than the Malaysian counterparts would be their focus on non-interest income. So to analyze a bank is very simple. Banks traditionally, we all know, take depositors' money, borrow it out, right? And then charge an interest to whoever takes up loan with them. And then once they receive the interest income, they will actually give out a portion of it to whoever who stores the money in the bank. And that is where depositors in your savings account, your current account get interest, is because the bank actually collects it and then they pay a fraction of it to you. Other parts of it where they actually churn out revenue without the fact or the fear of interest rates would be the non-interest income. So banks can also sell you investment products, can also give you different kinds of services that they usually charge a fee. And this kind of income does not get affected by OPR, does not get affected by interest rates. As long as they continue to push that non-interest income revenue, the bank's revenue or the bank's overall performance should be stable and does not fluctuate as wildly, because they do not really rely too much or too heavily on the interest income portion, which can be affected by the OPR and also other interest rate mechanism. So if you dive down into the non-interest income contributors of all the banks, interest income is very simple. They will just borrow out money to different kinds of party. You can actually deep down later, we'll talk about it, how to analyze the interest income portion of a bank. But now let's just focus on the non-interest income. So for DBS, straightforward, they offer wealth management services, transaction services. So you want to do remittance of money around the world, they will usually charge you a fee, right? And when they actually issue credit cards, right, when you use your card, when you swipe your card, the banks usually collect a merchant fee from the so-called merchants. And then, of course, any loan-related fees, one-off fees that does not tie back to the interest portion of a loan, the banks usually also earn a portion of it. Right, for OCBC, a lot of you would be familiar because the insurance pillar of OCBC, Great Eastern Group, many of you who subscribe to Great Eastern would be surprised or are aware that Great Eastern is actually a part of OCBC Group. So it is a very strong insurance pillar that has contributed a significant portion to OCBC's non-interest income. And then, of course, on top of that, there are other, incomes coming in the form of fees, commission, trading income, right? If you use OCBC to buy and sell stocks, right, you also contribute back to OCBC's non-interest income. And also, being a Singapore bank with a growing wealthier population, they also do offer wealth management, and that is also an important non-interest income contributor to OCBC. The last Singapore bank, but also has a huge presence in Malaysia, would be UOB. Right, a lot of you guys might be using a UOB card, and you are also maybe using their digital banking app, which is very user-friendly, right? So for the non-interest income of UOB, right, wealth banking, trading in terms of UOB Kay Hian, and then the credit cards and also wealth management are the important income contributors to UOB. So if I were to go back 1 year, because I still remember 1 year ago, I was also giving a sharing on in terms of Singapore banks. That was a time where a lot of things were still uncertain, but there are a lot of signs that the Singapore banks are ready to rebound. They were just lacking in terms of the net interest margin. So back then, 1 year ago, interest rates were still very low and banks were still affected by low interest rates. But coming on to the first half of 2022, right, you can see that the interest margins have actually improved significantly, right? Back then in the first half of 2021, the NIM for DBS was just 1.47. It actually went up to 1.52 as of the latest quarterly results or the first half results of 2022. For OCBC, the same also applies, right? They have actually seen their NIM go up to as high as 1.63%, and for UOB is actually as high as 1.63% as well. So you can see that everything is already coming to play. Back then, if you actually seen and predicted that the NIM percentage would improve in the coming quarters, you would have taken position, right? But coming in to this year, this is a confirmation that the banks were almost ready to actually recover when the economic conditions stabilize and slowly recovers from COVID-19 pandemic induced sell-offs. And I see questions pertaining digital banking. So here, purposely or anticipating the kind of questions that would be asked, you would be surprised at how fast in terms of digitalization initiatives the Singapore banks are. So if you are actually aware, UOB, they are aware that in terms of digitalization, they might not be as nimble, as fast, as innovative as the fintech companies. They actually partnered with Grab, right? In terms of many aspects, like linking your UOB card on the Grab app, so that you actually get to spend via UOB on your Grab app. So that does not mean that your fintech companies are going to totally disrupt or totally kick away the traditional bankings in terms of how banking is going to be like in the future, right? And of course, for banks in the likes of DBS and OCBC, they have actually partnered up with Google Pay. So now you can actually link your credit card on your mobile phone, let Google Pay do the encryption service, and tap every time you just use the public transport or whenever you go shopping, right? You don't need to bring your card in fear of your card getting stolen in terms of card data getting stolen, or even losing your physical card. You can actually just record or capture your card using a mobile phone under Google Pay, and Google Pay will even add in the additional encryption services. And this is how digital banks might also be not as I would say on par with your traditional banks, because they are actually working closely with a fintech company or with a tech company to actually improve user interfaces when it comes to credit card usage. Last but not least, if you come to Singapore, you will not see the proliferation of a lot of e-wallets. So back then in Malaysia, I still remember when you go to a store, you will see a lot of barcode, right? Shopee Pay, Fave Pay, a lot of different wallets to use, right? Some of them are not even present right now. They have actually gotten eaten up by other e-wallet companies. But back then, when e-wallets was a thing, the Singapore banks was like, okay, we need to ensure that the e-wallets don't come in and disrupt us. So what do? Right, we just make the payment more seamlessly, right? If e-wallet is all about barcode, well, the banks can actually come up with a barcode, right? And this barcode can actually be applied to by merchants, by business owners, and this is what they call the Pay Now initiatives, right? It's similar to Do It Now. They have been around before the e-wallets came in, and by using Pay Now and ensuring Pay Now is rolled out across Singapore, the banks actually continue to be the e-wallets of Singapore, right? They do not let the smaller fintech companies launch their own e-wallets and come and challenge them in terms of enhancing and seamlessly allow payments to be made whenever we buy something from a business. Right. So on top of that, the additional strength that I see from Singapore banks is that they always think outside of a bank's borders, right? So banks can be very traditional because the business model of bank has been around for many years. It basically just involves taking money from a depositor and giving it out to parties who they deem are trustable, and in anticipation that the money plus the interest can be collected back, and then a portion of it given out to the depositors. So that has been the business model of banks for the past few hundred years. But moving forward, how can banks stay relevant, right? Not get affected by fintech and not affected by other aspects. So banks have also become more conscious and more aware of the environment. So for DBS, they have actually come up with climate impact, which allows people to trade carbon credits. So carbon credits, as you all know, is one of the, I would say, tax that businesses might actually have to pay if they are actually pumping out more smoke, more carbon to the environment due to their business operations, right? To actually prevent that from happening, they might actually need to buy carbon credits, and carbon credits somehow become derivatives that is tradable in certain exchanges. So to actually aid that, DBS actually comes up with climate impacts to allow the trading of carbon credits, right? And this is actually working closely with Singapore Exchange, Standard Chartered, and also Temasek. And of course, if you talk about Singapore banks, they are not just solely operating in Singapore. They are having multiple branches and multiple operations around the world. So OCBC also has a stake in Ningbo Yinhang, or Bank of Ningbo, situated in China, and they also have a strong presence in Hong Kong and also Indonesia. And of course, digitalization initiatives. We want to bank easier, we want to transfer money more easier, we want to receive payment easier as well. So doubling down on the digitalization initiatives, making your app very seamlessly to use would actually also help customers remain with you. So on top of that, even if you are a UOB user, you can actually link your UOB card to WeChat Pay and actually use it in China, right? Sometimes before going to China and not having the relevant apps and the relevant payment methods set up could be a little bit scary and daunting. But if you're banking with UOB, you can actually use back your UOB cards, link it to a WeChat, and then transact smoothly whenever you are in China. So once you understand the key gist or the key operating measures of a bank, right? Understanding the interest income portion, the non-interest income portion, what are the aspects, what are the prospects. Then last but not least, it will be very the granular data, the metrics that you want to compare against, right? So these metrics are not new. You might have already been using them when you analyze your Malaysia banks. So first and foremost would be the net interest income or net interest margin. So I would say that more or less there, UOB and OCBC are slightly higher at 1.63%, but DBS not too far off, just behind by 0.1%. And then cost to income ratio, whether the bank is actually spending their operating expenses, keeping them at bay. They'll usually give you a guidance or KPI to meet. So all three banks are around 44%. Non-performing loans, right? We do not want the bank to give out loans to unscrupulous parties and then affecting the so-called delinquency issues that the banks may face. So there is also a KPI to monitor that, which will be the non-performing loans. So all three banks are actually below 2%, 1.7% for UOB, slightly higher, but not a huge concern. And then the efficiency of the banks running the businesses, right? The return on assets, so roughly 1.02% for DBS, 0.85% for UOB, OCBC coming in at 1.27%. Next, the return on equity of the banks, highest among all three will be DBS at 13%, second in place OCBC 11%, and UOB at 10%. Then only you go to the valuation part, the PB, the PE, and also dividend yield. So for DBS, due to the slight premium that it's currently trading at, it's actually having a price to book ratio of 1.5 times. The other two banks, I would say close to one times price to book ratio. The UOB at 1.13 and OCBC at 1.07. The PE ratio, I would say, would be fairly stable or ranging from 11 times to 12 times PE ratio. And last but not least, the dividend yield. If you buy off one of these banks at today's price, you are expected to get a trailing yield of roughly 4.5%. Which is considered okay for the banks that are listed in Singapore because of the size they're currently in and also the runway. They can still grow because they are not just fully focused in Singapore. They can also grow their businesses in Malaysia, in Singapore, in Hong Kong, China, and other parts of the world as well. So if you look at bank prices of all the three Singapore banks, you will notice that if you zoom it up and look at it from a long-term perspective, the bank price are always going up, right? So this is actually the max from back then until 2022. All three banks are actually giving you close to 100% plus of capital gains. This is just measuring capital gains without dividends. So in terms of the wealth preservation part of it, all three banks actually have done a very good job in terms of preserving wealth for their shareholders. Of course, along the years, you can see that there are dips, right? The red dips right here that here highlighted actually are showing you the drawdown, the share sell-off during the 2008 subprime mortgage crisis. So from a height of 20 bucks, it came down to as low as 7 bucks. So it was a huge drawdown. But nevertheless, if you look at it from a long-term point of view, the share price of DBS Bank actually eventually hit 32 bucks. Same goes for UOB, close to 30 bucks, and also OCBC at roughly 12 bucks. So of course, along the years, there were many other crises. So the orange crises would be the China stock market crisis. There was also a huge drawdown and a sell-off. And of course, the most recent one happening in 2020 would be the COVID-induced sell-off. So there is always correction happening, but due to the solid performances, the so-called size of the banks in Singapore, you can see that even though there are huge sell-offs, the banks always manage to overcome the sell-offs and then continue to go higher and higher. And this is what we want to see if you want to invest or put your money into stocks or banking stocks that can preserve your capital in the long run, and even actually growing it by close to 100% if you give the bank long time enough to compound your returns and also your wealth, right? Of course, on top of that, we also talk about the wealth accumulation part of investing in Singapore banks. So you do not want to just let your money sit there. You also want to receive cash dividend payouts every year. And you can see that all three banks actually do grow their dividend payouts every single year, save for what happened in 2020. But coming to 2021, a lot of the banks have actually resumed paying back their dividends and will actually continue to grow if everything stays true to their strategy and game plan. Right. Of course, it is not that straightforward when it comes to choosing a bank stock to invest. Here are 10 items. I will briefly summarize. Some of it we have actually covered to actually check before you choose to invest into a banking stock you want, be it a Malaysian one or a Singapore one. Right. Historical operating revenue. Is the bank actually growing their operating revenue? Then is the bank growing their operating profit? Per share performances, is the earnings per share growing? Capital adequacy ratio. So this is actually measuring whether the banks have enough capital and retain earnings on hand to withstand any huge sell-offs or huge correction whenever there's a financial crisis. So you have to dig deeper to check this out because we are running out of time. Cost to income ratio, we have talked about that. All three banks have around 44% in terms of the cost to income ratio. Other income streams, right? The non-interest income part, how are the banks thinking up the box to earn more money on top of just the traditional mortgage and loans? Industry and sector exposure. So are the banks too hugely exposed to, say, for example, oil and gas, plantation companies or whatsoever? So they usually will also tell you, and you need to actually gauge it yourself. Some people like to take on additional risk. Some people do not like it. You can actually gauge the bank's exposure in this if you analyze this item. Cash flow statement and non-performing loans. So cash flow statements mainly just tell you how are the banks bringing in more money from the operations, and are they actually sacrificing the non-performing loans to grow. So this one we actually touch about that. Last but not least, the valuation part, we have also touched about it. And last but not least, peer-to-peer bank rate comparison. Put all the banks that you want to analyze together side by side as we did just now, and then look at some of the important metrics that you focus more and whether the banks are actually outperforming and showing much more prospect compared to their competitors. Right. Last but not least, before I come to an end to my sharing, you need to understand why Singapore is such an interesting place to invest, even though it's just a small piece of land, right? Maybe the same type of just police on it. Because of the limitation in terms of many aspects, be it the land, be it the resources, be it the capability to compete with their neighbors. Internally, I think the governments and the people are aware, and they have actually put in more initiatives to plan ahead, to look further ahead, and to also execute better when it comes to growing their home ground. And as a Malaysian, I can truly tell you from the bottom of my heart, I have actually been very amazed by how Singapore companies, in terms of the REITs and also the banks, run their businesses until they are actually world-class and actually can grow out of their home country and become one of the world's greatest REITs and banks that are worthy of your attention, right? So this is because of the small size and the limitations that made them to become much more aggressive and giving much more initiatives to grow, so that they can always stay relevant and stay, on par with the global evolutions and development, right? And you might be telling me, well, it's very complicated, it's very troublesome, right? But I will just give you a straightforward, flashback on what we have just talked about in terms of the bank's historical performance. Is you can still maintain to invest in Malaysia, but you have got to accept that you may lose out even on the inflation and also on the ringgit losses, the weakening ringgit as time goes by. Right, the facts are already cast in stones. I'm not making up the figures right here. I'm just communicating with you heart to heart that there is solid proof that Singapore companies can outperform and preserve your wealth and compound your wealth better than your Malaysian choices right now, right? There are things that you cannot change in Malaysia, but when you choose to invest, can actually dictate where your wealth grow and lies in the future. And to wrap it off, I'm actually going to share with you one article titles, which is why super rich people are actually choosing Singapore as their home ground to invest and to store their wealth, right? If we follow just a fraction of what they are doing, we might not be super rich, but we might actually, choose to compound and preserve our wealth for the coming years if we actually think of that. So with that, my sharing comes to an end. I hope you actually, managed to learn a little bit on how Singapore banks and Singapore REITs have grown throughout the years, and you might have come across some of the candidates that you are interested in. Feel free to analyze more or ask me questions, and I will await them with much enthusiasm. Of course, if you are interested in more of our content, more of my sharing, you can find me at the various channels that I've listed here. You can scan the QR codes to connect with me on Telegram, Facebook, Instagram, and also YouTube channel. And if you want to type in a more lengthy questions, you can actually contact me from the email address right here. I will pass it to the host to actually wrap things up, or even coordinate the questions that you might be facing.
Yeah, thank you, Jupan, for sharing. Let me just share my screen. Thank you to all viewers as well for tuning in to this session. We will be starting our Q&A session very soon. I saw a lot of questions coming up. So if you have any further inquiries, you can still type them out in the chat box. We will try to answer them by the Q&A session later. So to know more about trading in Singapore, you can scan the QR code on this screen or visit the link for more information. You can also join the SGX Invest Telegram channel to get the latest market insights in Singapore. Simply just scan the QR code here to join the channel. And a quick reminder, if you want to open a trading account with M Equities LYH team, you can do so by scanning the QR code here or type 3 in the chat box. Our support team will contact you shortly. So for those who sign up today, you will get an extra 500 MQ points when your trading account is opened successfully. And for all current MQ members, remember to do the post-webinar quiz and submit a screenshot in it to claim your 300 MQ points check-in rewards. If you haven't registered for this event, do register now by scanning the QR code here on the screen so that you can get our post-webinar updates, including the recordings and also the quiz. We'll be giving out mysterious gifts worth up to 249 ringgit right after our Q&A session. Do stay tuned for it. So let's start our Q&A session now. So Jupan, the first question is from Julia. So she's asking, I believe it's a she. She's asking, does the 10 years return comparison between Malaysia and Singapore REITs shown takes into account the exchange rates?
Hi, Julia. Thank you for your question. So unfortunately, that the 10-year returns comparison between Malaysia and Singapore REITs shown, or all the historical returns shown, does not take into consideration of the currency exchange, right? So you need to factor it in mind, right? Some of the companies or some of the REITs might have been taking in top 2, top 3 spots, but that hasn't been factoring the so-called currency loss or currency weaknesses in currencies, and that you have to actually take note of lah. So that also means that wherever you invest in, be it outside of Malaysia or in terms of stocks in Singapore or even stocks in US, Hong Kong, you will also need to factor in the currency exchanges. You do not need to be very meticulous on it. You just need to look at the country's economy and what is the monetary policy of each country. Like 10 years historical exchange rate, whether the currency is actually going up in tandem or losing out. So if it's losing out, whatever returns that you are making for a company in that country might be eroded by the currency losses that you might take note of. You must also consider, right? So that is my answer to you. The returns shown just now does not take into consideration. So you need to take the high position spots occupied by Malaysia companies with a pinch of salt.
Okay, thank you for your answer. So the second question is Haslinda Minhat. He's asking, what's the current average yield for Singapore REITs?
It depends. I would say if you look at the relatively larger ones in the likes of CapitaLand Integrated Commercial Trust, Mapletree, Pan Asia, they are around roughly 5%-ish, right? Trailing dividend yield. Of course, other more solid REITs in the likes of Parkway Life REIT, I think that one's a little bit lower because it is too predictable and it is too the quality is high in terms of the properties quality and also the ability to continue to grow their rental. That's why there's a premium tied to the REIT, right? They will always trade at a higher price to book ratio. They always trade at a higher PE. They also actually will trade at a lower dividend yield because quality things always come at a higher price. So the same applies to whatever you're buying in terms of clothes, in terms of bags, right?
So it's lower for
Yes.
Singapore REITs.
Yeah.
Okay. So another question on REITs. So if REITs is paying out 90% of its profit, then how can the market price is trading more than their net asset value? Is it and also the second question is it possible to get dividend but lost in invested value?
Okay, this is a good one. So you must also understand for REITs and all other companies, when they actually, they run their operations, right? The business is always running day in, day out, right? And as an investor, you are actually a sleeping owner of the company. So yes, the company or REIT or bank can pay out, for REIT, they can pay out 90% of their so-called net property income. They pay it out to you. That doesn't mean that they are paying out 90% of their earnings, right? Once they pay it out, they continue to run they continue collect rental from their tenants, right? So they can actually continue to do that day in, day out, because so long as the business is continuing to operating, they will always have the ability to dish out dividends and distributions to you, and at the sole discretion of the management to determine how much or whether they want to conserve it. For normal companies, but for REITs, they usually have the competence to actually do that without actually jeopardizing the business operations.
Okay. So what about the second question? Is it possible to get gain in dividend and also then lose in invested value?
There is a possibility to that, because you will come across companies, REITs, banks, which are trading at very high dividend yield, right? So I think some of us may have actually encountered this kind of mistake. You want to find a very good dividend yield company, straight away you go to the screener. Okay, screener, show me a 9% dividend yield company. And then pop, there's a company with a 9% yield. You do not analyze the stock. You do not analyze the REIT. You put your hard-earned money there, but you must always understand dividend yield is always trailing, meaning to say that you take the dividend paid out by the company as of the latest, and then divide it by the share price. So if the company actually is paying out lesser dividends, but the share price or the unit price dropping at a higher speed than the dividend drop, you will actually get an artificial higher dividend yield. So you need to actually be aware of that. But if the REIT, a bank or a company actually is growing their revenue and their net profit and also their dividend, you would never or seldomly come across such circumstances. There are such circumstances, but it is more complicated. It could be due to many other factors. Say, for example, properties or REITs in Hong Kong are selling at a discount because they have just they are coming out, recovering later from the pandemic compared to other countries. There are also concerns of the geopolitical uncertainties, because as we all are aware, a few years back, there was a protest in Hong Kong, and maybe investors are a little bit more scared of investing into Hong Kong REITs. So these are kinds of circumstances that can happen. But if you do your risk analysis well, you might actually be taking advantage if you have actually the risk appetite to do so.
Okay, so find a balance between dividend yield and also price share.
Yep.
Okay, so the next question is W. Chen. Since US dollar is going up, is it a good time to invest in US REITs listed in Singapore? Maybe for example, Manulife.
I think you need to, that is one macro thing you need to take note of. But to dispel some of the fear that most of us might have, because rising interest rate means that borrowing cost goes up, like interest expenses also go up, and that can affect your REITs payout in terms of distribution, because the REITs might need to pay more interest income to the banks because they are borrowing money. But you also need to be aware of the bigger picture, which is interest rates goes up is actually a sense that the global economy is growing. When global economy is growing, REITs can actually increase their rental as well. So the rental, hopefully, in terms of the reversion can actually cover the interest expense, which is also increasing. So if the rental income is growing faster than the interest expense, you can actually come across a scenario where, yes, interest rates going up, but the REIT can still pay out more dividends because on the operation side, they're actually doing actually growing much faster than the interest rates. So this is something you also must take note of and not just stay away from REITs in a high interest rate environment.
Okay. So what about if they are paying dividend in US dollars, does it mean they are paying higher dividends?
For REITs listed in the US market, you need to take note of the 30% withholding tax. So they might be paying out lucrative dividends, but before you actually receive the dividends, you're actually going to get taxed 30% of it. For REITs listed in Singapore Exchange, even for the US ones operating in US but listed in Singapore Exchange, you might not need to be worried about that, but also do the additional due diligence, right? Because some of these US REITs, they have their niche, they also have their so-called challenges, and it's not just a one answer or one bullet to solve everything. You need to actually look at much more granular stuff. So for example, US Manulife REIT, why are their properties at, and for that particular state, is there any hiccups or challenges that the REIT is actually facing, right? So I think you need to dig deeper from the surface and come to a conclusion for the particular REIT you are looking at, rather than looking at the macro factor only.
Okay, so they are more towards US dollars or the dollar currency exchange.
Yep.
Yeah. Okay, so next questions, W Kai from W Kai is SGX liquidity a factor of consideration to invest in?
I would say you'll be surprised that Singapore Exchange, even though coming from a smaller country, the volatility and the volumes are actually comparable with Malaysia. You also need to be aware of there are many funds. Even if you look at some of the companies listed in Singapore Exchange, some of the US funds like BlackRock, JP Morgan, they're actually shareholders of some of the larger Singapore corporations. So that gives you some sort of assurance that there would be liquidity. There's also investments and funds coming from your US investment banks pumping and investing into Singapore companies. And if they are actually doing that, why are you not doing that, right? Because they are actually the best of what they are doing, which is investing into companies that can grow and achieve good returns.
So liquidity is actually not really an issue in Singapore.
Yeah.
Okay. So last question from Lam Xuewen. How to choose a good REIT to invest? Is it good enough to look at the dividend payout alone, or any other factors you would consider?
Dividend payout historically will only give you past performance, right? Because the REIT will always say that, yes, this is my achievement for the past 10 years. But as an investor, it's good to know that past record, they are there because at least whoever is running the REIT is actually competent enough to do so. But investing is always forward-looking, so looking towards the future, what the REIT can continue to offer and grow in the next coming 10 years. Right? We look at some good examples of Mapletree Industrial REIT. It was just a REIT like Axis REIT. They were very focused into properties in the industrial scene, your factories, your warehouses. But sooner or later, they'll be like, okay, maybe Singapore would not be a great place for industrial activities because overheads expenses would be high. People would not want to set up factories in Singapore. It would not grow that well. So what can we do? And the opportunity to venture into data centers, right? So there are a lot of initiatives into cloud-based applications, even using Zoom right now. It's actually hosted on a cloud by a server. And to host a server, you will need to have a data center. And that is where traditional industrial REITs like Mapletree Industrial saw the opportunity and pivoted to being a data center REIT. So you must also need to have the trust that these REITs can actually be very relevant to what we are actually going to evolve and what are we going to tap into in the next future, so that they do not suddenly come to a stage where, oh, I'm actually holding on to properties that are going to be obsolete, and there will be a huge drop in dividends and also the operating revenue. So that will be too late for investors to react. So also having the niche to look at REITs that are very brave in transforming would be an additional factor to aid your analysis.
Okay, so forward-looking.
Yep.
Forward-proof. Okay, so thank you, Jupan, for the informative sharing session. There are more questions, but I think our time is limited. So that's all questions that we'll be answering for now. If you have any further questions, you can always send your inquiries to MQ Trader social media or our WhatsApp number. Thank you, Jupan. I believe our viewers have learned a lot from you today.
Thank you very much for having me. And I hope our viewers are more than enlightened and get start their investing activities by looking outwards from Malaysia and really make a differences in your future endeavors and also investment returns by being a little bit more aggressive.
Yeah, thank you very much.
Thank you.
Okay. Thank you. Okay, for those who are interested in opening a trading account with M Equities LYH team, remember to send us your contact details via the QR code or type 3 in the chat box. And remember, you can still register for the webinar if you want to get our post-webinar updates. You can just scan the QR code here to register. So after the webinar ends, remember to do the post-webinar quiz and upload a screenshot into the quiz itself to claim your check-in rewards. So here's our mysterious gift session now. Remember that you can win gifts worth up to 249 ringgit. There will be questions and answers options shown on the screen. And for each question, we'll be choosing two winners from Zoom and one winner from Facebook. Total 3 questions. And if you have won before, we'll pass the chance to the next person. So everyone gets a chance in all 3 questions. And for winners, please remember to send us your contact details, name, mobile number, and also email address via the private chat function on Zoom and Facebook so that we can arrange the gifts to you. So get ready. Let's start the session now. You need to get your keyboard ready. Everyone answer very quickly. So get ready now. I'll start now. So number 1, how does MQ member get their 300 MQ points check-in rewards? So what's the answer? I see some wrong answer. So the answer is B, to upload your screenshot in the post-webinar quiz. Okay, the quiz will be sent to your email shortly after the webinar ends. So remember to upload a screenshot to the quiz itself. If you haven't taken a screenshot yet, you can take it now. Victor, give us a few minutes. Let us screen through the winners. So the winner is Adam and NK there on Zoom. And on Facebook, it will be Victor Ao Yong. So congratulations to all these winners. Remember to send us your contact details by using the template that we've shared just now. So remember to take a screenshot in the webinar. We need a screenshot within the webinar itself, okay? Number 2, ready, go. So according to our speaker, how can you accumulate wealth in the Singapore stock market? This should be an easy one as well. This is our title. So what's the answer? Okay, I see lots of correct answer now. Okay, the answer is A, to invest in Singapore banks and REITs sectors, which is a good way to accumulate your wealth. So congratulations. For Zoom winner is Stephen Lee and CH Tan. And for Facebook winner is NK Te. Remember to send us your contact details via the private chats function. For Zoom, the first question's winner is Victor Ao Yong. The second winner is NK Tan. NK Te. Te. Okay. The last question. Get ready. What is true about DBS Bank? A, B, C, or D? Okay, so the answer is D. It has the highest total asset value among all of the banks shown on the screen. Let's see who got the correct answer. For Zoom is Fu Chi Seng and Ahmad Faiz. Remember to send us your contact details, your name, your contact number, and email address so that we can arrange the gifts for you. And for Facebook, it is Liu Yuk Lung. So remember, for winners, please send us your contact details, name, and email address so that we can arrange the gifts for you. Let's wait a little while for the winners to send us their details. Once again, for Facebook is Victor Aoyong, NK Te, and also Liu Yuk Lung. Okay, so Facebook, remember to PM us your contact details so that we can arrange the gifts for you. For winners who have not sent us contact details, remember to do so now. And for those who haven't taken a screenshot, you can take your screenshot now to submit in our post-webinar quiz later. So while waiting for them to send their details, you're more than welcome to send us your inquiries regarding MQ Trader in the chat box, and I'm happy to help you with it. And for those who haven't registered, you can register now as well. Take your screenshot, submit it in the post-webinar quiz later. So once again, a very big thank you to all of you who have participated in our webinar today and made it a successful one. MQ Trader will be organizing webinars at least once every month. Remember to like and follow us on our Facebook and Instagram so that you won't miss our updates. And on our screen is our Merdeka sales. Remember to check out our marketplace tomorrow to see what are the things that you can redeem and also what are the things that are having discounts that is preferable for you. Okay, so remember to like and follow us on our Facebook and Instagram. Here's our Facebook show of hand. You can also follow us on our i3 Investor page for latest blogs and also articles on financial knowledge. You can also download the MQ chat to get the full features of i3 Investors. So if there are no any further inquiries, we'll end the webinar today and I'll turn off my camera. The webinar will be live for a few more minutes so that you can refer to the links in the chat box before it is gone. So I wish you all a fruitful week ahead. Happy National Day and Selamat Hari Merdeka. Bye-bye.
Thanks for watching.